In this discussion, we're going to talk about leases. And this is a rather complicated topic, but we are not going to consider every particular parameter here. It's just sort of an overview. So, some basic terminology here with regard to leases and basic classifications with regard to them. First, it's important to keep straight who the lessor and who the lessee is. So the lessor is the owner. The lessee is the buyer or renter. Each of these could be involved in an operating lease or in a capital lease. If it's an operating lease, the lease is behaving much like rent, just renting a piece of equipment or renting a building. If it's a capital lease, though, then basically accountants are wondering, is this really a case where equipment or a building has been purchased? And if in substance, we do believe that an asset such as a building or machinery or equipment has been purchased, often it's one of two types: either a direct finance lease, where just the ownership of the equipment is changing hands and there's some interest. In essence, you might look at the seller or the lessor as a bank. And if it's a sales type lease, then there might actually be some profit built in other than finance or rent type profit to the lessor. So the capital lease criteria. Every time we look at a lease, we try to decide, the accountant decides, is it operating or is it capital? If it's capital, it meets these criteria. First, it has a non-cancelable lease term, and then it has one or more of the following. First, if the agreement transfers ownership to the lessee, then we have a capital lease. Second, if there's a bargain purchase option, then we have a capital lease. And I have more to say about a bargain purchase option in a minute. If the lease term is more than 75% or equal to 75% of the life of the asset, hang on. Didn't have that written in here, but let's make sure we do. Then we have a capital lease. And if the present value of minimum lease payments is 90% or more of the fair value of the asset, then we have a capital lease. And I'm going to talk a little bit more about the time value of money. You saw it back in chapter 6 for the first time, and you would use time value of money concepts to figure out the present value of these minimum lease payments. So basically, if you look at this substantively, what we're trying to figure out is, is this really a case where the lessee is going to have the equipment or use it for most of its life? They're going to pay almost full price for it, and there's an option at the end for them to buy it at a very low price. If any of these criteria are there, or all of them are there, we think this is substantively a capital lease. Let's talk more about the last three items that might make this a capital lease. First, we have a bargain purchase option. So a bargain purchase option is a case where at some point during the lease, the lessee can buy the item at a price less than fair market value. Usually the first time you're trying to decide if this is capital or not is, of course, when when the lease has just taken place, when it's just transpired. So often the way bargain purchase is tested is that the accountant tries to figure out if the present value of the future lease payments plus any bargain purchase option is substantially the same price as fair market value. And if fair market value is a lot higher than the present value of the lease payments plus the plus the bargain purchase option, then we might say this really is a bargain purchase option. This is not a purchase option per se, it's a bargain one. There's a deal. It's expected that the lessee is going to buy this at the end. Let's think more about the term of 75% or more of the asset's useful life. And again, that should have read 75% or more. So here's an example of how you might apply that. If a company's leasing a building and the building will last 30 years, then the lease term should be 22 years and 6 months or longer if it's a capital lease. And if it's only a year or 2 or 5 years, then there's a good chance we have an operating lease. Let's consider the present value of the payments, of the lease payments. So if the present value of all lease payments are greater than or equal to 90% of the fair market value of the equipment, then we really believe that in substance the lessee is buying the equipment. So the example here would be, we have a building that's worth $1 million now, and the present value of future lease payments is $900,000 or more, then we would assume that this is in fact a capital lease. Here's a little bit more on the topic of direct finance leases and sales type leases. So the criteria, the determination we make about whether we have a capital lease or an operating lease is based on the test I just showed you. But typically capital leases could either take the form of a direct financing lease, and this is where the lessee is renting from the lessor. Obviously in the end, to be a capital lease, the lessee is going to wind up taking ownership or should take ownership. But really all the lessor is charging here is interest in the finance contract. So it's almost as if the lessor is a bank. But a sales type lease is where in addition to the interest, the lessor may receive profit on the sale. So again, each of these types of leases are typically capital leases, but we still may do a test on them. And if the tests satisfy the conditions of a capital lease, we'll have a capital lease. If the tests don't satisfy the conditions, we'd have an operating lease. So this slide deals with what happens if there are some costs in a lease contract. So very often the way this works out is during the lease term, the lessor is the one who's paying these fees. But often the lessor has worked it into the contract that the lessee has to pay for them. So you see the issue here then. The lessor may well remit the payments to others who are owed the fees, but usually then there'll be some sort of payable where the lessee, as part of the monthly payment, pays for these costs. So let's consider some facts and then look at a journal entry. We have Bill's Records, who has leased a vinyl record machine from Connor Leasing Corporation. So you picture this record label leases a vinyl record machine. They don't own one, but they lease it from Connor Leasing Corp. And Connor bought the machine from Capitol Records. When Capitol bought the machine, they paid this price, $479,000 and some change. And the way this lease is structured, there's 6 payments of $102,000 beginning on January 1st, 2016. And each payment contains a $2,000 maintenance fee. So this is the way the transaction would be recorded in each set of accounting records. So for the lessee, which was Bill's Records, we have a maintenance fee of $2,000, the lease payable going down of $100,000, and cash credited for $102,000. This then appears to be a capital lease because an operating lease wouldn't show up on the books at all as a lease payable, so there wouldn't be a big credit out there, and then we wouldn't be debiting lease payable. The lessor in this case, Connor Leasing Corporation, receives cash of $102,000. It's crediting its lease receivable from bills. And then there's a maintenance fee payable of $2,000. And this is because we're assuming that the lessor, Connor here, hasn't paid the fee yet. So in this case, the payable is going up, representing that now that Connor has Bill's money, it's going to have to turn around and pay Capital Records, or whoever it is that's handling the maintenance fee. Might be a bank too. Okay, now let's think a little bit about a sale leaseback type transaction, which is a certain type of lease. And we're not really going to dwell much on the accounting here. We're just going to think about this economic topic. So in a sales leaseback transaction, the owner, the old owner, actually sells the equipment to the new owner, and the new owner gives cash. But then immediately, the old owner now goes ahead and pays the new owner to lease the item, lease the machine or the equipment, and there's a lease there. So why do this? Why do a sale immediate leaseback? If you see this, the idea is that it's typically either done to cover for falling interest rates. And the other reason it might be done is to generate cash. Obviously with the falling interest rates, if the old owner bought it and interest rates are going down, it may work out that the new owner really doesn't want to get caught with the falling interest rates, so they go ahead and lease it right back to the new owner. And the final topic we're going to address in Chapter 15 is the discounted capital lease. So keep in mind, very often leases don't have interest rates on them. This is just a payment that's made here and there. So if we determine that a lease is a capital lease and there's no stated interest on it, what we're going to have to do is we're going to have to discount the lease to try to figure out what portion is principal, what portion is interest, and we're going to have to make an effort to record the asset as a debit to make the asset go up if we're the lessee. And we're also going to have to show a credit to a payable account, probably lease payable. So let's consider some facts. Let's consider that the lessee buys or enters into a 3-year lease. This 3-year lease requires 6 semi-annual payments of $139,857, and today the market rate of interest is 14%. So if the amount financed is something that needs to be recorded because we're treating this as a capital lease, then we might treat this as an ordinary annuity, much like in Chapter 6. So there's really no table in our book for monthly payments. So let's assume for the sake of argument that the lessee makes 2 payments a year. And obviously that's the way it's set up because there's 6 semi-annual payments. So then we would take the 14% interest rate, since the lessee pays twice a year, and we divide it by 2. So we have 6 payments and we have a 7% interest rate, which is what you get if you have 14% divided by 2. Now this, going back to Chapter 6, and our present value of an ordinary annuity, leads us to a table value in that table of 4.7665. And when we multiply 4.7665 times 139,857, we come out to an asset value and a note payable or a lease payable of $666,629. So here's how we show that journal entry on the lessee's books. The lessee is going to debit machinery $66,629 and credit lease payable for $666,629. Then we're going to go through an amortization table, much like we did for bonds and much like we did back in Chapter 6. And we're going to figure out how much of each of the $139,857 payments, how much of that was interest and how much was principal. And I'm not really going to go through the whole thing with you, but you can see that in period 1, there was a $139,857 payment made. At this point, the outstanding balance is $666,629. Multiply that by the half year, 7%. The interest portion is $46,664 of this payment. So the reduction in principal is going to be $93,193. If I were going to put that in a journal entry, and I didn't have it here in the slides, the journal entry would be a debit to interest expense of $46,664, a debit to lease payable, which reduces lease payable, of $93,193, and a credit to cash for the whole amount of $139,857. All right, that's a basic overview of leases and really some detailed stuff in there, but rather simple stuff. So if you have any questions, let me know. Otherwise, I hope you do well in the chapter.